Good morning, everyone. I'm Andrea Solomon, and on behalf of the entire Development and Alumni Relations team, it's my privilege to welcome you to another webinar in the Choate ConnectsUs series. We created this series to keep the Greater Choate Rosemary Hall connected during the time of social distancing. We hope you'll join us for next week's webinar on COVID-19's impact on sports and the discussion on education in these challenging times the following week. Today, we're going to have a conversation about disaster lending and a couple of programs under the CARES Act. We'll speak with 3 experts about how you can maximize the benefits of these government assistance programs. Today's discussion will be led by David Javdan, a member of the class of 1986. David is Managing Director, Head of Government Affairs, Large Cap Private Equity at Alvarez Marsal Management Consulting, and former General Counsel of the U.S. Small Business Administration after 9/11 and Katrina. Welcome, David.
Welcome. Well, thank you so much for having me here. You know, it's exciting to keep the Choate community close, and I know there are a lot of people out there that are entrepreneurs and you know, within small businesses and large businesses, and so we're here to help everywhere we can. And the only thing I'm telling myself is I'm going to try and not tell any Dan Corsi stories while I'm on this phone. It was a privilege to have with the class. Yeah, I think he could do more damage to me than I could to him. But anyway, look, really appreciate being here. A lot has been done on the CARES Act and PPP, but a lot is changing too. The new rules and regulations that are very, very relevant and important just dropped on the Main Street Lending Program, you know, literally about, 20 minutes ago or so. So we'll be covering some of that as well. So we do think a lot of this is relevant. I'm going to compress my discussion on some of the PPP to be more about newer information that's come out and less about the overall. Just a quick backdrop. Again, David Javdan, class of '86. I'm a partner at Alvarez and Marsal, as are my 2 colleagues here. We're known as the world's largest restructuring and turnaround firm. We like to say we're heart surgeons, not undertakers. We got our start in bankruptcy, quite famously running Lehman Brothers in bankruptcy, Washington Mutual. More recently, some high-profile ones have been Toys R Us, Forever 21, a few others I can't name right now, but retail is certainly taking a lot of pressure. So we come at this from the position of people that try and help save companies. My focus has been less on the bankruptcy side, more on the private equity side. Our purpose here really is to talk about government programs and assistance that you can have. If there's any follow-up, any questions anyone has, you know, please feel free to reach out. I've got 2 colleagues on the phone who know about various aspects of the CARES Act. Tom Shaffer, who has been spending all morning analyzing the new materials that come out on the Main Street Loan Program. You know, a Harvard MBA, but you know, I'm adopting as a Choate. He wanted to go into public service. The FBI wouldn't let him carry a gun, so he went in and went into the CFO's office of the FBI. So knows a lot about what you can and can't do in government. Kevin Jacobs, you can blame him for all the misery at the IRS because he pretty much ran it for a while. But I'll let them tell you more about themselves. My most relevant here is not, by the way, who I am, but who I was. I was general counsel of the SBA post 9/11. That's pretty much why I joined the SBA, to go help after 9/11 and after Katrina and Rita. And so I'm intimately familiar with the various loan programs. It's not how I make my living. So to be quite clear, the purpose of this is to help our community. I'm happy if people have questions or issues, you know, do reach out and help. You know, we'll be happy to help. This is not something that we charge for or anything like that, or that I charge for. So I do want to be clear with that. And happy to help anyone from your local house of worship, which are eligible under some of these programs now that are traditionally not eligible, to others. So to take a real big step, the CARES Act, you know, people talk about it different ways. The CARES Act includes many things that people don't think of as the CARES Act. It's the payroll protection program. It is certain tax and HR provisions that have been done. It is the Main Street lending program. In certain industries, it's direct loan programs. Again, if you've got any particular areas or particular specialized industries or questions, feel free to reach out. High level, I'm going to talk about the SBA disaster lending programs now, one of which was created by the CARES Act, one of which predated the CARES Act. And again, most of this information is pretty current today. There's been a lot of coverage about it. First, I will discuss the traditional EIDL program, Economic Injury Disaster Loan Program. Less relevant to a lot of you, but could be very relevant when we talk it because it will help you understand. There's a lot of aspects about the PPP people find confusing, and I think you'll understand. So the traditional EIDL program was an emergency direct lending program. A hurricane hits. You go to the SBA itself. They have a cadre of about 1,000 sort of, I'll call them seasonal employees, people that come and go, sort of hopping through disasters. You're dealing with the SBA directly. They make determinations. You put together a loan application package through the website, and that has traditionally been up to $2 million, a 30-year fix, one potentially 2-year deferral. The 30-year fix is usually pretty light, somewhere, let's say, a 3% loan, and it's really to give you working capital to keep your business going. It is not normally a forgivable loan. Sometimes there might be a minor grant aspect. In this case, there's potentially a $10,000 grant aspect, which is not a usual feature of the loan. There does not have to be sufficient collateral for the loan, but the loan traditionally needs a collateral, what collateral there is. Even if it's not sufficient, they want that collateral. And very critical in a lot of these things, and it goes into the issue of what's a small business. A personal guarantee is needed at least for a portion of the loan. Now, even though the SBA loan is subordinated to other loans, so you can get it without getting into too much what we technically call mishigas with your banks. And so it is subordinated. There is one part that isn't. When you do a personal guarantee, it's to the United States government. And so like your student loans, that's not something that you can just easily discharge in bankruptcy. So something to be very careful about. And as I think you can see from that, the personal guarantee aspect, it really goes to what one would traditionally call a small business. SBA in the United States, it's very unusual that they usually have a separate small business agency and then a medium business enterprise. We lump you as either small or large. So as you'll see under the PPP program, there's some businesses that could have 500 or 1,500 employees that are still considered small. It's not that way in most countries. And the EIDL program uses the traditional SBA definitions of small, which is much smaller than what you'd see in the PPP program. So you would really look to your NAICS code, and depending on your NAICS code, generally if you're manufacturing, it would be a number of employees. For non-manufacturing, it would be an amount of revenue. It's a complicated area. There's a guide that SBA puts out, MI Small. The EIDL program was pretty much overwhelmed in the most recent, as of Monday, however, 4 days from when we are doing this, an additional $70 billion was put into the program. That $70 billion can potentially allow more than $70 billion to come into the program. You would go to the SBA website and apply for that EIDL loan program, EIDL, and that stands for Economic Injury Disaster Loan. It's basically business interruption insurance issued by the SBA. Traditionally, hand in hand with that insurance, there is a physical damage loan. So after 9/11, Goldman Sachs, its building was physically damaged. It qualified to get a physical damage loan. You don't need to be a small business. For the physical damage loans, you've traditionally not needed to be small businesses. For this particular disaster, the physical damage has not been applicable. So you really are only going to see the economic injury. For the economic injury loan, you do need to be small. Now, the EIDL loan program was overwhelmed. They said, okay, normally at most you have something like Hurricane Katrina, which was Louisiana, or maybe you have a hurricane or a 9/11, but it's still a local geography. Congress realized with all the people needing help, we've never had a disaster declared in every single state and territory of the United States previously before. So they created the CARES Act. Originally, what the CARES Act was supposed to do was basically take the EIDL program you had before and put it through your banks, as opposed to going to SBA, because SBA was overwhelmed. And they did that and added a small grant component. Unfortunately, there was such a demand for money, it was changed from a loan program with a small grant component to basically a grant program. Whereas if you don't fulfill certain obligations, it will become a loan program. So right now, the PPP, which had run out of money, but now has been reinstated in money. As of Monday, the money was flowing again, and it's Thursday when we film this. You go to your bank. They do have to go through the anti-money laundering and other aspects about it. So if you can, it will help you pretty quickly if you have a pre-existing relationship. For a lot of people I know in the Choate world, the venture capital and the private equity aspects are going to be important. I'll get back to that shortly. You will fill it out with your bank. You can borrow up to 10 weeks, 2 months worth of payroll, with the limitation that amount you're borrowing, it can only be for salary up to $100,000, but it can be benefits that would take the total package up. So you will look at 2.5 times your average payroll, and that's the amount you could borrow. In order to take the money, you have to qualify as a small business. What qualifies you as a small business? There's a safe harbor for under 500 employees. So one you have to look at, including part-time employees, but not independent contractors, am I fewer than 500 people? And then there's an affiliation rule, which is of grave importance to venture capital and private equity. I'll come back to the affiliation rule. That's one test. That's a safe harbor. Second test is if you fulfill the obligations to the traditional SBA size standards. So that would mean, like to say, if you're a telecommunications company, you're competing against AT&T and Verizon, you shouldn't be 50 people, you can be 1,500 people. Or if you're a manufacturing company, you can be 1,500 people. So you look at that size standard. A third size standard that you can go to is, hey, minus your goodwill, is your business worth 15 million or less, has had 5 million of revenue, not including, tax loss carry forwards for the last 2 years. That's another safe harbor. You will count as a small business. Then there are the affiliation rules, and the affiliation rules basically say, hey, am I really a small independent business, or do I really belong to someone else? And in franchises, this has always come up. So after 9/11, a big issue for us was, hey, are you Dunkin' Donuts? Well, Dunkin' Donuts is a huge business. We're not going to lend money to Dunkin' Donuts. Or are you a franchisee of Dunkin' Donuts? Well, we could lend you money. And Dunkin' Donuts I use specifically because they had gone through and said, yep, we checked. The franchisees are really independent enough that you're lending money to a small business person that's running the franchise. You're not really lending money to Dunkin' Donuts. And so that issue comes up in franchises and other areas. It has also come up with respect to venture capital and private equity investment. Now, more traditional venture capital investment has basically, under the rules, come out to be pretty well safe. You only have to disclose who your investors are to the extent they own more than 20%. Most venture firms don't tend to own more than 20%. They tend to do a club sort of deal structure and all of that. Now, of course, there are certain rules about giving up the right to control the company through voting and other rights. But if you disclaim those, if you're under 20%, they're not even going to know about you. If you're above 20%, they're going to start looking at issues that really go to, do you have actual control? Now, the rules and the guidance they'd given out with more traditional private equity investment, they'd come out until, last Friday and this Monday, and basically said, yep, if you got private equity investment, to the extent it's below 50% and you don't exercise voting and other control rights, you're in a safe harbor. If you follow those rules, it qualifies as an independent business. It can get money. I think there was a lot of outcry, a lot of front page of the Wall Street Journal, New York Times articles, and there's been a shift. They haven't retracted that rule. They haven't retracted the normal, oh, you have to get credit elsewhere, be able to get money. They've still waived that rule, but they've said now that, hey, wait a second, you have to sign a certification that says, well, this loan is necessary because of the uncertainty of economic conditions. Previously, that had been interpreted to allow private equity or anyone else, because for everyone, the uncertainty of current economic conditions, no one knows where this is going, had allowed them to get money. Guidance that came out Friday and then today has basically indicated that even if you're a small business, if you're publicly traded, you certainly, it is almost impossible to qualify for the program. And that if you have significant private equity investment, it would be very difficult to qualify, which they're not calling a reversal, but looks pretty much like a reversal of what the rules were. So that's an analysis you can look at, and that's something we're happy to talk through with anyone, because it's far too complicated here. And again, that's not anything we would charge anyone for, to talk through those issues. So let's say you do qualify. You can borrow 2 months worth of payroll, and payroll includes benefits, things like paid family leave, vacation time, all those things. Pretty broad definition of benefits. You apply to your bank for money. You have to fill out the applications. We have all the forms. If anyone wants it, you can find them pretty easily on the Treasury website on Assistance for Small Business. You go fill out the forms with the bank, and you pretty much self-certify, which is why you have to be careful. Normally, when you apply to the SBA on the disaster lending program, you just put in the information you have, and then SBA will make the determinations about whether or not you're small. In the case of this program, you certify that based on what you know, you're small, basically under penalties of perjury. So if you make a mistake and you just don't understand it, no one's going to give you, probably they're just going to disallow the loan and you'll have to pay it back. If they think that you were fraudulent or you didn't have a good faith basis, there can be criminal penalties. And given a lot of the attention that's been paid, I would the media that this has gotten, I would encourage people to be extremely careful and cautious. Consult with your lawyer, your tax advisors, other people about that. To the extent you get it, you put it in, and actually for most people, they've done the application. They almost instantly get certain links to upload supporting documentation, send it to the bank. The bank processes the loan. SBA does not double check it or look at it. They basically are using delegated authority. They get a loan number from SBA, and they've been, in certain cases, distributing the money pretty quickly. You get it in your account. The minute the money in your account is in your account, it's sort of burning in your pocket. It is a loan, with a 6-month deferral, but you can have that loan forgiven for whatever you spend in the next 8 weeks. That are so long as they are fit within the criteria of what they've said, and the primary criteria is payroll. So basically, anything you spend on payroll can be forgiven. There's certain other things like rent, utilities. A lot of people are looking at utilities payments pretty broadly. In this day and age, my cell phone counts as a utility. That's a position people have been taking. There's not been any specific guidance on that. All that is okay as long as it does not exceed 1/3 of payroll. Or put in another way, payroll can be 75%. Everything else is 25%. That money that you spend from the minute the money hits your bank account to 8 weeks later, you can apply for forgiveness for that. So I do think there's been some confusion of people. They're like, all right, I got the money. I'll use it for my payroll at some point in time. The minute the money hits your bank account, the clock is burning. You can retroactively pay people. Not a problem. Something that we recommend a lot of people look at is you may have employees that are better off on unemployment, and if you just pay their benefits, and keep their benefits going, but let them otherwise take unemployment, they might make more money. we recommend you do that analysis because you don't want to do anything to hurt any of your employees. But if you do that, we're also recommending to people that you let your employees, particularly for ones that you want back, you let them know that's why we're doing this. Hey, we're not calling you back because we don't want you. We're not calling you back because we think you're going to make more money with us paying your benefits. At the end of those 8 weeks, you wait, you get the pay stubs, everything from your payroll providers, and you turn back to the bank, apply for forgiveness of the loan. The bank has 60 days to make a decision on that. It's the bank that makes the decision, and to the extent that you use the money for the appropriate purposes, it becomes a grant. Anything that was not used for an appropriate purpose, and I want to be clear, you still have to use it for the purposes they said, but it may not be within the 8 weeks. It may not be, you can't go use it to, let's say, pay down another loan or something like that. Anything that's used in the appropriate, for the appropriate purposes will be forgiven. Anything else converts into a loan at 1% that you have to pay back within, a year. That's it for that program. For the EIDL program, I have, again, that is more the 30-year fixed. I've heard that it is incredibly slow. It did get the $60-70 billion added to it on Monday. The applications are open. That is a longer-term program. I think that's something to keep an eye on. You apply, you're supposed to get an answer, an initial answer. Within 3 days, you're supposed to get a $10,000 grant. Then within a couple of weeks, you're supposed to get a loan if you qualify of up to $200,000, and then the $2 million could take longer. Right now, there's no idea. We don't know if people will be getting $2 million loans. We don't know if they'll be getting $200,000 loans. There's so much demand on the program. I do think it's something for people to really look at because it fits a liquidity need, but people don't really know where it's headed. Again, there's been a lot of front pages of newspaper coverage about this, and including this week. New guidance is coming out every day. We do think these are very helpful programs for startups, venture capital. It has now become probably less useful for private equity, though they're not 100% ruled out. It does become very difficult, and so it is something that we do encourage people to look at. Other sources of liquidity, however, are available through the Main Street Lending Program, and I will turn it over to Tom to talk about
that. Thanks, David. This call was scheduled yesterday before we knew that Federal Reserve and Treasury were going to come out with guidance. So, again, this is pretty hot off the press. What I think we'll do to keep it simple is the first part of the Main Street presentation. I'll just outline what the program was, as of a few hours ago, and then the guidance came out. I'll try to tell you what changed. And so obviously, you guys all can connect with David. I believe Andrea said class of '86. So if you want any follow-up materials in writing, it summarizes this. We're certainly happy to provide that under separate cover, but the stuff is all coming out pretty hot off the press. So first, so the Main Street program, generally speaking, even before today, but even more so given the news that came out this morning, was really focused on organizations that were larger than the ones that David mentioned, that would, in other words, that would not qualify for the small business. And so until the guidance this morning, the restriction was you could have up to 10,000 employees or $2.5 billion in 2019 revenue. So again, pretty different from the small business. And the premise was there are really two programs. One was a new loan and one was an expanded loan. New obviously is self-explanatory. Expanding was basically taking a loan on top of basically just updating a new tranche of your loan. And so the restrictions, again, that were as of modified this morning, but were previously in place, was that the existing debt on a new loan could not exceed 4 times 2019 EBITDA with a cap of 25 million. And for the existing expanded program for Main Street, it could not exceed 6 times EBITDA up to a cap of 150 million. And you could not have more than 30% of, the new tranche money could not be more than 30% of your existing debt. And so that's where we were, again, as of a few hours ago. And then the new and the interest rates were SOFR plus 250 to 400 basis points. And the new guidance that came out this morning had a few changes to it. And the first is they added a new program, a new priority program. And so the new and expanded programs basically are the bank holds 5% of the loan. And the Fed and Treasury take 95% of the loan. And that's still the case even with the new guidance this morning. Under the new priority program that just got announced this morning, that percentage is 15%, 15. So in other words, when that program gets rolled out, the bank will hold 15% of the loan, the Fed will hold 85% of the loan. The other key changes that came out again in the last couple hours is that the minimum loan amount has actually gone down. So prior to today, it was $1 million across the board. Those amounts have been reduced for the new and priority loans to $500,000, and expanded or increased for the expanded loan to $10 million. So again, capturing some borrowers that might be a little bit lower on the profitability scale. I'm sure that wasn't an accident given the guidance. A couple other notes, changes that literally made this morning through the guidance and frequently asked questions. The expanded Main Street program had a $150 million cap, which you just mentioned a minute or so ago. That has gone up to $200 million. And the 30% that I mentioned a couple of minutes ago of the percentage that your new tranche cannot exceed of your existing debt went up from 30% to 35%. They also clarified in the guidance the payment schedule of your first year, similar to the SBA loan that David just mentioned. The Main Street loan has a 1-year deferral for principal and interest, and it just clarified, the new guidance clarifies for each of the new priority and expanded the percentage that needs to get paid in years 2 through 4, because the loans were and are 4 years in length. Additional guidance, they put specific language out about how to define EBITDA. And so that was, as you can imagine, a big deal, because most companies, there's a difference between traditional unadjusted EBITDA and adjusted EBITDA. And in layman's terms, basically, they said, however you've been defining adjusted EBITDA on your current debt or otherwise in sort of the normal course of business, this is how you define it. So again, for companies that will be eligible, again, pretty favorable. And again, the details matter. So again, we'll be putting this in writing and distributing it. You can just go through David if you're interested in it, or just you can also Google it for details. A couple more important points. They clarified that the new loan or the expanded loan, basically any of the Main Street loans, could not be subordinated to other debt. And again, the devil's in the detail, and is much better to be produced in writing, but that's the punchline. And then a couple other notes. The old loan, or the previous guidance, had SOFR plus 250 to 400 basis points. The new guidance came out this morning is now LIBOR plus 3%. And so changing the baseline to LIBOR, and then instead of the range of 2.5% to 4%, they went with 3%. And then last but not least, they also defined the way they count employees. And so previously, or the employee count restriction, sorry, the ceiling was 10,000 employees or $2.5 billion in revenue, like I mentioned at the beginning. And those numbers have gone up to 15,000 employees and $5 billion in revenue. I haven't had a chance this morning, just because I've been in meetings and this just came out, to dig into the details, but it looks like at a surface read that the employee count also includes affiliates. So as David mentioned earlier, the way that the SBA counts employees, it looks to be the way that they will count employees for purposes of the Main Street lending. And so in the case of for example, controlled private equity transactions, that would mean that you'd have to add up all the employees across the portfolio that were under the control of that private equity fund. I think that was it for the punchline. I would say that, again, there's going to be guidance coming out in the coming days, probably to even re-clarify some of the nuances, but a lot of the guidance that came out this morning, this is being taped on Thursday, April 30th, has been really helpful, and A&M will produce summary content, have that, certainly probably today, if not tomorrow, which you can, of course, receive through David Javdan. Or, you could sort of just Google and read. A lot of law firms are going to put out information on this as well, that kind of highlight the guidance that's relevant for the Main Street lending programs. In addition to Main Street, there are other programs that are sort of still to be determined. And so there's a Treasury Direct program that initially, when the CARES Act was signed a little over a month ago, was meant to be, again, for companies that, roughly speaking, didn't qualify for SBA. And the law said that the interest rate could not be above 2%, and was, again, predominantly for businesses between 500 and 10,000 employees, and that principal interest would be deferred for at least 6 months. We're still waiting on further guidance to come out on the Treasury Direct program. There are some businesses that the initial view was that a lot of the restrictions that were put in place by the CARES Act, to name just a couple, that you couldn't pay dividends, and couldn't have any stock buybacks for, I think it was the term of the loan, I think it was plus a year, and that, and there's also some executive compensation restrictions that were pretty tough. And also, the Treasury Direct program also required employers to keep 90% of their workforce to revert back to 90% of their workforce as of February 1st, within 4 months of the national health emergency being lifted, and then also to restore 90% of the recipient's workforce by September 30th. So, some companies, or just, both companies and private equity owned portfolio companies, just found those to be pretty restrictive. And so on the Main Street side, those restrictions were a little bit loosened. And again, no stock buybacks is still in place for the term of the loan. Oh, sorry. On the Treasury Direct, it was the term of the loan plus 2 years. You couldn't outsource jobs. You couldn't abrogate collective bargaining, and you had to remain for the term of the loan plus 2 years, and you had to remain neutral in any union organizing event. And so on the Main Street side, those restrictions are a little bit lighter, and that you couldn't buy back stock for the year of the loan plus, or the term of the loan plus 1 year, and the same for dividends, and the same term for executive compensation. So a little bit less so. And then most favorably to business, those 90% provisions I just outlined in the Treasury Direct program about having to retain, or increase workforce to be 90%. Those 90% numbers, those are not applicable to the Main Street lending. Specifically, you had to make reasonable efforts to maintain payroll in your workforce. And the guidance that came out this morning, again, I haven't read the fine print, but the summary level was that basically they defined it in a pretty general way. So essentially, reasonable efforts, based on the circumstances of the business and the operating environment. So again, broad strokes, the Main Street lending, both prior to today and with today's guidance, is still generally less restrictive than the Treasury Direct program, whose details are still to be determined. There are also some other programs. There's some, if you own a company or involved with a company that does manufacturing and exports, there's some programs through the Export-Import Bank that have been expanded and highlighted. And again, probably not for mass consumption, but if anyone's interested in those, we have materials that we can send you through David that could be helpful to understand what those programs are and what you might be available for. So with that, I'll turn it back over to David to fill in any details, and then ultimately to Kevin Jacobs, the head of our National Tax Office, to talk through the tax implications of the CARES Act and otherwise.
David, for some reason we can't hear you.
Sorry, when my junior associate came in, I had hit the mute button.
You can't trust them,
You can't trust it. I'm sure he sells more copy than I do. One of the reasons why I've tried to highlight the Export-Import Bank and some of these other loan programs, let's say EIDL and all that, is because people keep looking at resource guides to programs created by the CARES Act, and that's very, very important. but what gets lost is there are a lot of existing loan and other programs that are getting, there's no legislation, they weren't affected by the CARES Act, but they're being reinterpreted to help folks in America. So while it's good to look at things that are CARES specific, it's very important to remember that there are other programs and assistance that's available that was not created by the CARES Act. One of them is the XM program. What I want to highlight is XM has been expressed a willingness. Traditionally it was known as Boeing's Bank, to allow people to do that. It has created a few new programs that are particularly helpful to smaller and mid-sized businesses. And while they've not done it yet, they've expressed a willingness to consider not just traditional manufacturing, but let's say if you were a software company, or let's say if you were a services company, potentially, supporting that. I think the software probably a little easier than the services. We do encourage you to look at those programs. Now to that, let me turn it to Kevin Jacobs. A lot of these programs are run by the tax side, and like I said, Kevin is the boogeyman to many of you. He joined us from the IRS, where he ran a lot of this stuff, which I always like making fun of tax guys, because having been trained as a lawyer, they're the only people less popular than we are.
Well, thanks, David. And I think I got it in spades, being both a lawyer and doing tax. So being a tax lawyer, I win. I am the National Tax Office practice leader. Before joining A&M, I was with the IRS Chief Counsel for 6.5 years, and the Associate Corporate Office, in part monitoring and helping coordinate the division's response to TCJA. And so just as that was hectic, the times now are definitely equally as hectic. We thought it would be helpful to also highlight, in addition to all the loan programs, some of the tax provisions, some of which are already been discussed with the FFRCA associated with the payroll side of paid sick leave, as well as FMLA, as well as some of the business provisions. With the FFRCA, they came out and they said that generally effective April 1st, employers with fewer than 500 US employees need to provide sick leave or emergency family medical leave, ACT leave, related to certain COVID-19 absences. And so if you have fewer than 500 US employees, then you need to provide this leave. There is associated payroll credits. Just to note that with all of the provisions in which there's any sort of numbers or employees, there's some aggregation rules, of which each of the aggregation rules are actually different. So how you apply or whether or not you qualify for aggregation rules varies for each individual provision. And so we definitely encourage you to reach out to your advisor to sort of walk through the aggregation rules and determining whether or not they do apply. One of the big provisions, assuming you don't qualify for the PPP, is the ability to defer an employer's portion of Social Security taxes. The CARES Act provides that if there are any employer portion Social Security taxes that are due from March 27th to December 31st of this year, then they can be deferred with 50% payable on December 31st, 2021, and the remaining 50% on December 31st, 2022. The IRS came out with guidance recently that's very taxpayer favorable, which provides that you are able to defer the employer portion of the Social Security until there's actually receiving a notice that part of your PPP loan is going to be forgiven. And so as a result of that, it's definitely something that we're encouraging all of the employers that are eligible to take advantage of this, because even if you are receiving a PPP loan, you can still take advantage of this and enabling you at least to have some deferral. The IRS decided that they didn't want to be upended and have Tom have all the funds. So last night, they released 44 pages of frequently asked questions associated with the employee retention credit. The employee retention credit is part of the CARES Act and is another provision that's focusing on payroll as opposed to income tax. In essence, what it does is it provides a credit equal to 50% of the qualified wages for each employee, with the maximum credit being $5,000. Obviously, from a maximum liquidity standpoint, furloughs and layoffs are going to provide a greater benefit. But if employers are looking at keeping their employees on the books, they should definitely look at whether or not they qualify for the employee retention credit. For this purpose, you have to look at whether or not the employer averaged over 100 employees or 100 and fewer in 2019. Again, there's an aggregation concept there, so you may have to aggregate with other taxpayers in determining this. And if you have over 100 employees, then it's with respect to services that they're providing during either a governmental shutdown or the quarter in which they had a significant decline of profits. It's important to note that in determining that, the IRS's recent guidance has really narrowed the scope of what constitutes a government shutdown. And so it's really important that you make sure that you fit within the provisions if you're planning on claiming the credit. They have noted that if you are open for business or you're an essential business, but you're suffering from a lack of customers, that does not qualify. However, if, for example, you're an essential business, but you're having difficulties because your supplier is unable to make deliveries, then that does qualify. So you can see the nuances that are associated with whether or not you do or don't qualify as being subject to a fully or partially suspended due to a government order. Additionally, they have the gross receipts test, which is less than 50% of the gross receipts for the same quarter compared to the prior year. And so once you meet that threshold, you can continue to claim the credit until the quarter in which the gross receipts are greater than 80%, obviously through the end of 2020. They gave some very helpful guidance as far as how to calculate gross receipts and when do you determine 50%, especially in the PE and venture capital space. They provided that if you're acquiring a company, you're able to utilize the historic gross receipts in determining whether or not you had a significant decline. And so that's a helpful guidance that they provided. The ERC is also a refundable credit, and so there's several ways that taxpayers can take advantage of it. They can either request it in advance or on their quarterly Form 941, where they're reporting their quarterly employment taxes. The reason why I wanted to spend a little bit more time or focus on this is because truly the provisions that are in the CARES Act, at least with respect to the tax business provisions, generally only apply to corporations. And so if you have an entity that's operating as a partnership or flow through, those are pretty much the CARES Act ERC and the deferral are going to be the provisions that are generally going to be applied to you and that you'll be able to utilize for liquidity. And so I thought it was important to highlight those provisions. If you do have a corporation, then there's several other things that the CARES Act provides that you can take advantage of. For example, they offered the modification of net operating loss rules. As part of the TCJA, they eliminated the ability of carrying back net operating losses. And so as part of the CARES Act, they had for taxable years in 2018, 19, and 20, you can carry back your net operating losses for 5 years. They also provided subsequent helpful guidance that says you can claim these on a Form 1139. And 1139 is a tentative refund form. It's important when you're thinking about what form to file. There are timeframes that each form has to file, whether or not you want a tentative refund or an amended return, as well as the processing time. For example, 1139 does not require the Joint Committee of Taxation to review the refund prior to its issuance, versus an amended return requires the Joint Committee on Taxation to review it. They also removed the 80% limitation on taxable income for using the NOLs in this year. So it truly is a provision that was designed to increase liquidity by allowing taxpayers to either utilize their losses in the current year or to carry back their net operating losses to prior years and generate refunds. To that end, they also accelerated the timing for the refundable AMT credit. As part of TCJA, corporations were no longer subject to calculating and paying an AMT tax. And so they always had a minimum tax credit, which was the amount of previous AMT that was paid that you were able to utilize to offset your regular tax liability. TCJA provided that it was going to be then become a refundable credit over a span of 4 years from 2018 to 2021. As part of the CARES Act, they amended it and provided that you can accelerate that refund and claim it in either 2018 or in 2019. So as a result, you have corporations that are looking and saying, did I generate a net operating loss in 2018, 2019, 2020? And if so, should I carry it back? Additionally, you have corporations saying, well, did I use a net operating loss? And if so, can I utilize more of it to offset my tax liability? Additionally, did you pay AMT in past years for which the refundable credit is available? It's important to note that corporations should go through and review all of their past tax returns to determine whether or not they're eligible for this relief. And in doing so, they also have to be mindful of contractual limitations that may arise in their ability to either claim these credits or to carry back the NOL. For example, in venture capital or PE deals, sometimes the contracts prohibit the acquirer from carrying back to pre-acquisition periods. And so you have to really be mindful and also review the purchase agreements associated with those transactions. Additionally, if there's consolidated groups in the mix, there's complicated consolidated group rules that govern the carryback of net operating losses. And so you have to see, is it beneficial for me to carry back those losses because I might be generating a refund for another taxpayer, which clearly was not the intended result. Currently, Treasury is looking at potentially giving additional guidance that will provide relief from that result, but under the currently issued guidance, that is the result. As part of TCJA, they also limited the amount of interest that can be deducted under 163J, and the high-level view of what they've done is they've increased the amount of the limit associated with 163J, and so taxpayers are able to deduct more of their interest in 2019 and 2020. And with a view again to obviously increase the amount of their deductions, possibly generating an NOL that they'll be able to carry back. They also amended how you can calculate the base amount to which the limitation is calculated off of for 2020 in an effort to further increase the amount of interest that's deducted. The only other provision that I wanted to highlight is it's called the retail glitch fix. And so for those that have the improvements on an interior portion of the building in which it's non-residential real property as part of the TCJA, they provided accidentally that the useful life of the property is 39 years unless they elect ADS, the alternative depreciation system, for 40 years. And as a result, it was not eligible for 168K bonus depreciation, which is now 100%. As a result of the CARES Act, they did amend this and retroactively have it for TCJA as if it never had that useful life. And so now, as a result of the CARES Act, the taxpayers are able to amend their 2018, 2019, or potentially also filing a change in accounting method in 2019, 2020 with respect to how to claim the depreciation for the QIP, which is the qualified improvement property. And so again, as you can see with all of the provisions, there's really not a one-size-fits-all approach. And so it's really imperative that you discuss your situation with your advisor, because you have to say, okay, is it beneficial for me to claim this in which year? What is the consequences? There's many moving pieces. For example, you may say that you're increasing the amount of my interest deduction under 163J, but then I might be subject to the base erosion tax penalty, and so now I have foregone that benefit. And so am I better off just deferring it to a totally different year? And so we definitely encourage you to meet with and speak with your advisor to discuss what is most applicable. The only other thing I wanted to mention is, obviously, as you can hear on this call, there's always going to be late breaking news. It's very important before you act, you sort of see what is the most recent guidance. If we had this call yesterday, both Tom and I would be talking about totally different things, as well as the fact that states have different sets of rules. I highlighted what the federal provisions provide, but each state has the ability of adopting their own rules. Some states automatically adopt the federal rules. Some do it with modifications. Some have to adopt it or otherwise it doesn't apply. And so it's important to look at each state in which you're filing in to determine also not only what the federal tax consequences are, but what the state tax consequences are. So with that said, I guess those are the high level views of what the tax provisions are. David or Tom, do you have any other thoughts that you think it would be helpful to share?
A lot going on. If we were live, I'd take questions, but this is pre-recorded, so Andrea.
Sure. Well, a huge thank you, Tom, Kevin, especially you, David, for a very informative and helpful conversation today. You were literally helping us with hot off the press new information, and I know that our alums and parents and community will certainly appreciate all of the information that you shared. And I know you're very, very busy, so we really appreciate your time. Thank you to everyone who listened. We look forward to being with you again soon. Please stay tuned for future online programming in our Choate ConnectsUs series and check our alumni webpage for more information. Have a wonderful day and stay healthy, everyone.